Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. Verizon's dividend yield is getting a lot of interest from investors, and I get it. After all, it's a big company, generates lots of predictable, recurring cash flows. But here's the thing. That big dividend is no promise for big future returns for investors. We're going to talk about why that's the case here on The Smattering. I'm Jason Hall. I got Tyler Crow with me. Hey, Tyler.
How's it going, Jason? Yeah, Verizon's always been one. It gets very tempting because you look at that, even during good times, dividend yield better than 4%, something like that. And it can look very attractive. But, if you're buying dividend stocks, it typically means you want to buy and hold for a very, very long time, right? You're looking for 10 to 20 years of consistent dividend payments, consistent growth, and generating your excess returns with some combination of modest growth and good dividend payout. And this is where Verizon starts to fall short. So even at today, we're just going to run through a small example here using a couple charts. Right now, Verizon's dividend yield is about 6.33%. And telecommunications, pretty slow growth industry, right? Well, I'm going to just give you 3 other companies in what would be considered slow growth, mature industries, right? Not somewhat comparable, a decent comparison stake. We're going to use Nucor, a steel maker, Union Pacific, a railroad, and Southern Company, an electric utility, all right? So Verizon, 6.3% dividend yield, Nucor, 1.3%. Union Pacific 2.4 and Southern Company 3.8. Obviously, dividend yield for Verizon looks most attractive right now. And, if you're using yield as a proxy for valuation, that looks great, right? Now, if I were to compare this over a very, very long period, 25, 30 years or more, that Verizon has done a total return of about 855%. Compared to the S&P 500 on a total return, though, the S&P has done 2,200%. So we're already significantly underperforming the S&P 500 on a total return basis. Conversely, the companies I also mentioned, Nucor, Union Pacific, Southern Company, have all more than tripled the S&P 500 on a total return basis over this period. Now, this is not to say that high yields are bad or anything like that, because there are plenty of companies that have high yields that have produced total returns in excess of the S&P 500. What I'm trying to get at here is that Verizon in particular has not necessarily been that, excess value in excess of the market kind of returns that you as an investor should expect from an individual stock. That when you are making an investment in an individual stock, there should be some expectation that this individual stock is going to beat some broader market index. Be a little hesitant when you're seeing these high yields or all-time lows, because even if that's the case, it doesn't necessarily mean that you're primed for them to return to where they were or to produce excess gains.